Hey guys, what's up? This is Andrew for TrendSenses.com. So I didn't make an update for quite some time, guys. I'm so sorry about that. I was actually resigning from my job so I can be full-time here with you guys, sharing the knowledge about trading and making updates every day. So today I want to make a massive one, guys, a big, huge, massive update because there are a lot of things to say on GameStop. Let's get into it. So as usual, we're gonna start on the 4 hours time frame, guys. I think it's the best time frame to use when you do technical analysis for the reason that it's both used by long-term investors like institutional clients and short-term traders. So the signals that you can find here are the best signals for me. So I'm gonna maybe just recall what I was saying in my last video. So my last video was done actually quite some time ago, guys. It was done on the posted on the 3rd of June, but it was done, I think, the day before. So GameStop was around 250, something like this, we were here, all right, in this area. So let me just remind you what I was saying, and then I'm going to show you my different scenarios. So for now, forget about that, guys. We're going to see this very soon. All right, let's keep it like this. So here, guys, you can go and check this video, guys. I was basically telling you that we are bullish. We were in this 5 waves development. So 1, 2, 3, 4, 5, and we were in the 4th wave. So I was telling you guys, we are waiting for the 5th wave. That's the reason why I was bullish. I gave you a target of 300. We went actually slightly above, 50 points higher, but this day was very interesting. I'm going to come to this. We basically blew the 300 level on the upside, but came back right away. So here, basically, there was a lot of bearish signals. I'm going to go through this. I'm sorry, guys, I didn't give you the signals when they were happening, but I told you that we're going to correct to 220, which we did. So I'm going to explain exactly what I mean by bearish signals. And you're going to see that each time these corrections happen, so we can expect those corrections to happen on the larger degree wave counting. And I have here 1, here is a 2, you see? So I'm not sure the 2 is here or here. We're going to discuss this very soon. And I'm going to give you what you hear for, guys, which is actually how to time and how to know when the 3rd wave is going to start. I'm going to go to this very soon. But first, let me here finish the analysis on the shorter term. So basically, this 5th wave was expected. The 2nd wave here was expected as well. And I was telling you that here you can use a trailing stop loss using the moving averages. So once again, I just want to show you guys how this worked here very well. So basically, I was telling you the 50 period moving average on the hourly time frame is a very good support level. So you can see one reaction here, one reaction here, so 2, 3, 4, 5, and here, guys, look at what happened. It's just, I can't be here always with you. Maybe I'm going to do some live updates very soon now that I have resigned from my position. But once again, when you resign from a position like mine, it takes time. You need to prepare what they call the handover, which is basically showing everybody what you were doing, how to use the spreadsheets, how to work in your environment, and basically do what you were doing. And this takes like 1 week or 2. So I'm not going to be free right away, but very soon, guys, I'm going to be here every day with you. And here, look, we broke this 50 period moving average. And then, as usual, we are retesting it. So here we have your signal. Let's check on the 4 hours time frame. On the 4 hours time frame, the signal was too late, you see. So that's why when you do short term, the 4 hours time frame is a bit lagging too much. It doesn't give you the retest you need to enter your trade, but the hourly time frame gives you your retest. Here it's broken, confirmed, and then here retested, and from then we went lower. So this was here, guys, once again, a very good signal to use. And I was telling you guys this all the way up. I was telling you, don't sell if you don't have your bearish signal. So this is one of them. But let me show you all the other signals that we had here. So something that you guys know I like to use, for those who are watching my videos for some time, I very often come back to this because this is for me a very precious indicator, which is divergences. So let me show you quickly what are divergences. So here we are going to focus on the classic one, which is the regular divergence in the bearish mode. So basically the price action is here in blue. and you can use any momentum indicator, stochastic, RSI, or MACD. I like to use it with MACD, but it's working with all of them. And basically the market is making new high. So you can see here we're making new highs, one high here, second high here. And in the same time, the momentum indicator is giving you a bearish signal because you can see that the momentum is going down. It's making lower highs, which means that the market is out of steam, which means that the bears are gaining confidence and that the bulls are not able to take ground as much as they used to the preceding moves up. So let me show you exactly how it looks here. So basically you just connect the highs that you have. So one high, second high, third high, and look at the MACD in the same time, guys. So the MACD during the same time was just doing lower highs. So you have the market making higher highs and the MACD making lower highs. All right. So this means that the market is out of steam. This means that the move down is to come. So you had this signal actually here already, and you can see it's not that easy to use, but you need to associate those with the other indicators that you are using, because here, 1, 2, you already had the divergence here. You can see on the 2nd of June, here it was already a divergence, and still the market got rejected, but managed to make a new high in a very sharp way. But look what happened, guys. It didn't last. It didn't last even 1 hour. When I go on the 4-hour time frame, you don't even see this strong move up. I mean, the candle is just a doji candle, all right? It's like we go very strongly up and then we get rejected. All the buyers here, they got stuck, guys. They lost money. And so bears took confidence. And from here, this is a very strong reversal candle that associated to what was happening before. You knew that here you could expect some correction to start. One more thing, guys, is that it's interesting to see that here we had a kind of weird phenomenon that happens sometimes. Let me show you guys this. So in this fifth wave, actually, you don't find 5 waves, you know, 1, 2, 3, 4, and you have 5 waves, but the fifth wave is truncated, all right? So it happens sometimes, you know, it's just bears that suddenly manage to beat the bulls. So here the bulls, basically, they were not strong enough to hold against all the sellers, probably hedge funds mostly. And yeah, this is the kind of things that can happen sometimes. So here I have an incomplete wave counting in my fifth wave. So we have a truncated fifth wave, which is something that can happen. So it's not easy to trade. But once again, guys, we had the bearish divergence. We still know we are in the fifth wave. And we knew that this first wave that is here, guys, let me take a step back, needed to correct at some point. So the higher we go, the better it is, guys, the better it is. Because once again, let me show you something that is very interesting. I have so many things I want to show you guys here, but we're going to do them one by one here. The reason why it's good to go higher is because I told you guys that if you are not comfortable with trend lines, I like to use trend lines. That's why I found the 220 level. All right. That's why I told you for already, like I was telling you for already more than 2 weeks, that we're going to correct to the 220 level. We went to 207, something like this, but you can see that on a 4-hour time frame, the 220 level is holding very well. It's not broken. Here it's tested. Here we close below, but here we managed to close above. So you don't have 2 consecutive candles trading below this level. So this level is holding for now. This level is very strong. I'm going to show you the different scenarios. There are some scenarios where we trade below this level. But don't worry, guys, in all of the scenarios, we finally trade much higher. I'm going to come to this very, very soon. But here, let me just show you how to use fibs. Some of you were asking me to show you how to use fibs. So I think it's interesting. I'll show you now. So you measure the first wave. Now you know this wave is complete. You knew it already for some time. You knew it when we broke the 50-period moving average on the hourly time frame. You knew already. Or it's working as well with the 20-period moving average on the 4-hour time frame, the blue one that is here. You can see it's supporting the price the same way. Here it's broken, retested, and then we go lower. So here you knew, but actually you could know even here after this doji candle, guys, when we have this kind of strong moves up and all the buyers get caught here, it's not good. All right, so you measure the wave and then you apply the Fibonacci ratios. So once again, Fibonacci is a method-based golden number that is a number that you can find everywhere in everything that is growing. You can find it in plants, you can find it in anything that follows a growing process. So markets is one of these things. And so here, when you measure this wave, then you usually retracing. I'm actually right now, guys, making a full course that I'm gonna share with you, where it's gonna be comprehensive training where I explain all the methods that work for me. I'm going to explain to you guys how to use them exactly in which situations. So that's why I resigned from my job. This is going to take me a lot of time to do, but I'm already doing it. And you're going to see that in this course, the method I'm going to give you guys to enter with fibs. Some people, they like to buy here and here. I mean, the 38.2, I don't like to buy this level. Sometimes we only retracing here, but most of the time, we're retracing to the 50 or 61.8% retracement. So here I would be a buyer at 240 and at 215 using only fibs without using trend lines that require some more skills. But even if you are not able to draw efficient trend lines, you can still use fibs, which is much easier to do, and that is working very well as well. So here, buyer at 240, buyer at 215. We're gonna see with trend lines that here we have a strong support as well. And then in the fibs method, below the 1.786% retracement, basically the scenario is off the table. So if you are just using fibs in a bullish market, you should stop loss your position here below the 180 level. So this is giving you some levels beyond which the bullish scenario is off the table just using fibs method. So in my scenarios, we are not getting there, don't worry, but this is just something that you can keep in mind. All right, so here I'm done with fibs. So once again, now we completed this fibs wave. We saw that we had some signals like the bearish divergence. Let me show you again quickly. This regular bearish divergence that was telling you that the first wave is gonna be complete soon. So now what are our different scenarios? So let me show you again. You just type Elliott wave on Google, you go to the third link and you find the PDF. This is the book, guys, that I read that is very complicated, that is basically explaining to you guys everything about the different wave formations, how they work together. And what I want to bring you to here for now is the corrective waves. So I'm going to show you guys that basically we have here three scenarios, actually mostly two scenarios. So by the way, I actually already did some training about that, guys. Just click on the link in the description of this video and you're going to receive this free training that I've already made that is around 1 or 2 hours, where I explain in a very basic way all this theory that is very complicated. And I think that is very interesting for you guys to start getting familiar with Elliott waves theory. And basically here, corrective processes come in two styles: sharp corrections angled steeply against the larger trend, sideways corrections. So basically this is where I wanted to bring you guys, and we can have a zigzag or we can have a flat. We can also have triangles, but triangles very rarely occur in second waves. So here we either gonna have a zigzag or a flat. Now this correction was sharp enough to be done. So the question we're having here, so the first question that you guys having is this correction complete or not? So let me just start to label this with you. So A, B, C. So this could be our zigzag. This could be a complete correction. Once again, the C wave itself is in 5 waves. As you can see in the book that I just showed you, I'm not going to go through this here with you again. 1, 2, 3, 4, 5. So this is a C wave. So this ABC correction could be complete. And one of the scenarios, I'm giving you here my first scenario, which is basically the one that I'm calling for 2 or 3 weeks, guys. You can go and check my videos once again. I told you we're going to go to 300. We went slightly above, but we didn't really close above on the 4 hours time frame. And then I told you we're going to correct to 220 and then start the third wave. So this is one of the scenarios. Now, another thing that is interesting to take into account is that you can see that this wave lasts from the 11th of May to the 8th of June. So basically 1 month. So when you have a 1 month move up, usually, even if the correction is sharp enough in spot, to me, maybe we're gonna consolidate here a bit more. So we have 2 different possibilities from here. Either this is just a first move, and then we're gonna do basically another zigzag that is just a bit longer. So something like this. and then we could go here, or even here, we could do a flat. Then, you know, we can do basically, I'm going to give you the two scenarios in the same time. Either we do a flat, so something like this, or we do a zigzag. So depending on how high the B wave is going, it's gonna impact the C wave as well. All right, the higher the B wave is going, the less likely it is that the C wave is actually going below wave A. So we're gonna have a look at how this B wave is developing. But here, probably on Monday, we're gonna be a bit consolidating maybe at the beginning of the session, and then probably go strongly higher. And then this is when you're gonna have two different scenarios. Either we already starting the third wave, or we're actually doing an ABC. So once again, first scenario is this one that you're having here. Second one is, for example, this one. Sorry. Second one is this one. So we're going to analyze what is happening here. If the first scenario plays out, so once again, the first scenario is going to be like this. So if the first scenario plays out, guys, it's easy to actually see, because we're going to have a 1, 2, and then 3. All right. 4 and 5. And here you can see that the two scenarios, they're both going to do the same thing. In any case, I think we're going to trade higher on Monday with some impulsive moves, but we need to pay attention. Is this first wave in 5 waves or not on the, for example, 5 minutes time frame? If here you have 5 waves, this is probably meaning that this is a 1, 2, 3, 4, 5, because then the 1 is motive. On the other hand, if here we have only 3 waves, then this move is corrective. So pay attention of, if you see something like this, then probably this is motive, and here you're going to have zigzag, and then 1, 2, 3, 4, 5. And here, if you have something that is looking more like this, then it means that probably this is just an ABC, and that here we're going to have a 1, 2, 3, 4, 5 going maybe to the 195 level. Why 195? Because it's the maximum of the B wave here. So I prefer to use trend lines, but once again, if you use fibs, you can see that this is working well as well. Using fibs show you that all the area that is above the 180 level is a buying area. All right, guys, so let me just sum up here the information I was giving to you. So basically, I think that this correction is either done or not. We're probably going to have some moves up on Monday. For me, the levels to buy are everything between 220 and 195. If we trade below 195, I would start to be a bit careful, but you know, I don't want to trade too long below this level. I certainly don't want to see a closing daily candle below the 195 level. But once again, let me remind you guys, look, this is AMC, so I'm going to come to AMC very soon. But just to remind you guys, you know, so the AMC is here. So GameStop just did the first wave, you know, just to compare, guys, look, AMC is one step ahead. GameStop just finished its first wave after this huge breakout, and is now retracing and doing the second wave. AMC second wave was very deep in terms of retracement. So I think it's interesting to see that we went to the 98.6% retracement level. That was a bit tricky. This is not usual, but we need to keep in mind that GameStop can have the same behavior. All right. So if we have the same behavior, this means that GameStop would go to the 180 level roughly. So we might go there a very short period of time. So yeah, just to keep in mind that this scenario is not making my bullish scenario weaker. I mean, maybe slightly weaker, but still very, very achievable. And once again, I'm not sure if we're going to consolidate here or not, but in both cases, the third wave is going to start. And pay attention in the number of waves in moves up. If you have 5 waves, this is motive. If you have 3 waves, this is corrective. So this is one method that you need to associate with all the other indicators that you are using. We don't like to see divergences. I don't have any bearish divergence on the larger time frame. So this is very good to me. And now I want to bring you guys to the financial data that is very interesting to have a look at. So this is my dashboard, guys. All right, so we are here on GameStop. So first, let me maybe show you guys the option open interest. So once again, for those who are watching my video for the first time, I'm here making updates often as I can about the synthetic short interest that we have on the option market. I can hear a lot of different things regarding this option market, but I'm an option trader. I mean, I was, because I am resigning. So I know how to use this data. So basically you take the open interest, you multiply it by 100. This is the formula. and you multiply it by the delta and of course the spot price. And this is giving you synthetic short exposure. And once again, to get the delta, I just use Black-Scholes formula. I do this for all the maturities. So you can see I put my maturities here, and the Black-Scholes formula is this one. All right. So it's just basic Black-Scholes formula. And by doing this, you are having the real exposure, and you can have this for every maturity and every strike. And it's very interesting to see that for GameStop, guys, as I'm telling you all the time, look what we're having on the 800 strike. Guys, even for AMC, we didn't have such a big exposure here. And it's very interesting to see that this exposure, guys, is coming mostly from the 18th of June. On AMC, it's coming from June. On GameStop, let me show you where it's coming from, this 800. So we're having 3.5 million shares. And coming mostly from here, guys, as you can see, right? Mostly from here. So this is July, all right? This is the July maturity. So it's mostly coming from the July maturity, guys, which is very soon. So I expect for this reason, because the gamma, this is creating some gamma on the upside. And it's this gamma that is creating the beginning of the squeeze, even if it's not a real squeeze, like I said already for AMC. Because a real squeeze is much sharper. For now, we're just having a healthy bullish development on AMC, on GameStop, of course, as well. And in this bullish development, what is creating the momentum? For now, it's the option interests that we're having on those very out of the money strikes that are priced on a very high volatility. Guys, look at this, 380%. It's very, very big. And this is what market makers need to use to price those call options if they don't want to get destroyed by the price action moving higher. And one other very interesting information is here that, for example, the delta is the probability of finishing in the money. So you can see that the delta of the 800 strike on the July maturity is 18%, guys, 18%. So this means there is 18% chance, according to the market makers' models, that we finish above 800 in 1 month. For me, it's more something closer to 50%, all right? But this is what the option market is showing us. So this is, of course, very bullish. And when I see this, I know that if the price action starts to go higher, so in the third wave, typically, we're going to have very strong moves up. All right, another very interesting information is here. I compute since I started my channel, guys. So in November, I'm recording this very important data, which is the equity float, the outstanding number of shares, the short interest, 12 million shares short interest, guys. So this is a lot. It's around 20% of regular short interest. So of course here, I don't take into account the naked shorts. I know they are in this market. I know they are, but you can't find them anywhere. And what is interesting is to see if this data, which is good data, is growing or not. For now, you can see that it's stable. So of course, the shorts have not covered. And the synthetic short that I get using the information I get on the option market is right now 10%, guys. All right. GameStop is at 230. We're having 10%. Imagine GameStop is going to 800. We're getting 23% of short interest, 10 billion USD. So this is the money market makers need, the position the market makers need to buy around 9 billion US dollars. They need to buy this. This is the money that people who have call options, the exposure they're having. So market makers, if they don't want to be left short, they need to buy in this market. So this is the reason why it's so bullish. So just let me come back here. So the short interest is stable, 12 million shares. Compared to the 14th of May data. But once again, this data is, almost 2 weeks old. So I'm wondering what it is right now. But for now, it's stable. What I don't want to see is here a drop. I don't want to see a drop in volatility as well. So this is January 23. But in the short-term volatility, if you see a drop here, it means market makers are not scared anymore. And they need to be scared for this squeeze to happen. I mean, this healthy bullish development to 800 to happen, which is not the squeeze yet. The squeeze will come after this, when market makers, hedge funds are going to increase their short positions and then they can get squeezed. So that's it for me, guys. I hope you enjoyed this update. It was a bit longer than usual because I had a lot of things to tell you. So we are bullish. Everything is fine for me. We can go as low as 180, and my bullish scenario is still going to be my preferred scenario. I think we can consolidate maybe 1 or 2 more days, maybe 1 more or 2 weeks. This is possible as well. So this is, in this environment, we need to pay attention to how many waves we have in the moves up. This is how we can guess if we are now developing in the third wave or if we are still correcting in the second wave. So if you enjoyed this video, guys, please please don't forget to click on the sub, like, and bell button so you're going to be the first to know when I upload anything new. And stay close to shore. I'll see you guys.